Good morning, I'm Jill Malandrino, Global Markets Reporter at Nasdaq. And for this Wednesday morning, markets are in the green with the Dow leading the way as Nasdaq-listed Apple had blowout quarters Tuesday after the market closed. And Brad, you think that this can lead to more short squeezes?
I can, as the markets grind higher, putting the S&P 500 in better and better position relative to active management. The hedge funds are getting a lot of money pulled, and that's creating a lot of short squeezes as they're getting their assets pulled.
Right. Well, it's interesting because there were a number of earnings after the close last night that were not good, but they're trading, in some cases 8–10% higher this morning. That, to me, sounds like a short squeeze in effect.
And it can be very, very powerful when a lot of assets are getting pulled out of one asset sector. Look at energy over the last 2 or 3 years. When people move, they're moving in flocks. And so if hedge fund managers are long and short stocks and they're having to pull out of assets altogether, that's creating some buying in some pretty highly shorted names.
Right. Well, I mean, we're seeing that in energy as well. I think also from an earnings perspective, because they are really comping against poor numbers over the past year or two.
Yeah.
And you're seeing that sector rotation. In fact, last week, that was the #1 sector out of all the S&P 500 sectors. And even yesterday, it was trading about 1% to about 1.5% higher as a group.
Yeah, and they've been pretty blown out to the downside.
Right.
Energy, so it's a pretty low expectation group, to say the least.
Well, and I also think that people are wrapping their head around the fact that, okay, oil is going to be in this $40 to $50 range, so we can kind of take that out of the equation and really look at how core operations are for each individual company, and I think that's what makes the energy sector conversation more interesting too.
And it is, and the whole conversation we're having just this specific minute, one sector's down, other sectors are doing well. The dispersion is much better for traders in this environment to be able to do anything.
Right. Even if you look at the 11 S&P 500 sectors, there's a number of charts that I use. You could literally see 5 up, 6 down, or the inverse, whereas July was a great example of it, where you'd have 9 up and maybe 2 down. So it really does give you the opportunity for some sector rotation. I'm wondering if it's a function of the overall market or if it's because we are in earnings season and we sort of have something with corporate data to actually trade off of versus just macro.
I think it's a little of both, really. The amount of shorts that are in the market have actually been declining some. Some of the rates that we check in to, when for instance, Shake Shack, we were looking at the borrow rate, because when you short a stock, you have to borrow it from the bank. Sometimes they charge you interest. So 56% or 54% of Shake Shack is short. However, the borrow rate is general collateral, which is very advantageous for the short seller to borrow. It doesn't cost anything. So you can tell that the marketplace isn't like dying to short in this environment.
Right, because you would think it would be more expensive.
That's right.
On a stock that has the higher short interest because it would be harder to borrow.
That's
but you're seeing that borrowing costs really aren't that high.
That's right. So for instance, like an SQZZ, which is the ETF that we run, looking for these things, GNC has been a favorite of ours this last week. The short interest is tremendously high, 40–45%. You're getting almost 18% to lend it out in that situation.
Right.
Whereas Shack is even more shorted, but yet there seems to be plenty of supply.
Is that a trend that you haven't seen in a while, or is it fairly common?
No, this is a very
new.
low, not low, but not new, but over the last few months, we've definitely noticed that borrow rates have improved quite a bit.
Which means that
it's
traders aren't looking to short
as much.
And there's that old adage too, you never want to short a quiet market or a market that's consistently going up.
Right, well, that's true. Sentiment's awfully high, so I would disagree in this instance.
In terms of bearish sentiment.
Yeah, that's right. I still am very bearish on the general markets. So there's certainly some stocks that are popping and cherry picking. We had Garmin in the fund today, GRMN, popped on some good earnings today. But for the most part, it's kind of a mixed picture so far.
It's really interesting managing SQZZ, Nasdaq listed SQZZ, because there's a lot of forces in play. You have to think like a contrarian. You also have to have a market opinion, and then you are buying stocks that are heavily shorted, which you want them to get squeezed up. So you have a whole bunch of different market forces that you have to look at.
And then you have to take the security and then lend it out for interest. So there definitely is a lot.
So it's also an income play.
An income play. So there's a lot of different pieces that you have to be watching. Garmin, we don't get to lend that out for any interest just because it's general collateral, but it's a 4% dividend yield, so we like that.
All right. Well, thank you very much for joining me at Nasdaq. As always, and traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.